We have an amazing blessing for you today. Just an absolutely fantastic guy. No idea actually what he's going to specifically talk about, but it doesn't matter because just about everything that could come out of his mouth is going to be of use to you. So I didn't even bother to screen tonight's presentation. His name is Justin Wohlstadter.
There we go.
See? Wohlstadter. Justin, for the YouTube edit. This is Justin Wohlstadter. And he's New York based, but spending a lot of time in Hong Kong these days. He comes from an educational background that I wore the hat for, right? Harvard undergrad, Oxford graduate school, and lots of venture capital stuff in New York City. Recently has become increasingly wrapped up, as often happens in the venture capital world, with one of his startups, and that's why he finds himself more in Hong Kong. Also a startup on the side that he may or may not talk about in the education space. We'll see. So, you know, guy like this, he's going to be involved in dozens and dozens and dozens and dozens of different companies to give you all sorts of insight into. So please join me in welcoming Dustin.
Okay. Yeah, thanks for having me. I'm not sure what your background is, whether any of you have done a startup before or thought about doing a startup before, so I'm kind of going to keep it a bit ambiguous, and feel free to hop in or ask questions afterwards or whatever. I'm happy to talk about whatever. So to start, bit of background on myself. As you can tell, I'm very young. I'm probably your age. I don't know if you guys go straight out of undergrad, but I had an opportunity from a very young age to build a venture capital firm in New York. Right out of undergrad, I got a call from a friend. He said, "Hey, I've got this guy who wants to start making venture capital investments. Can you help us build a venture firm?" So I joined him, and 2 years later, we invested about $30 million in about 30 portfolio companies. We invested in everything from a fruit cup company in California to a company that makes mechanical arms that make things weightless to web startups. A few of which, so Kevin here actually was in the class previously, a master's student here as well. And one of the startups we invested in, Kevin now works for and I now work for, called Enterproid, which makes a really cool mobile technology we can talk about later. We're hiring. But throw that in there. Yeah, so I've had exposure to a lot of different startups. I'm really passionate about startups, so I love talking about it, and I'll be talking about that today. So to get into it, first of all, that the slash kind of got erased, but I'd really encourage all of you, if you're thinking about, I think this is a one-year program, so I don't know if you guys are already looking at job opportunities, whether you're already talking to companies, startups or large companies, but I'd really encourage all of you to heavily consider joining a startup. And a startup maybe is a company of less than 100 people, maybe less than 50 people. It will give you an incredible experience. I know a lot of large companies like to talk about the fact that, oh, well, it'll be a good stepping stone, it'll be a good thing on your resume, but at the end of the day, getting exposure in a firm where your project, the success of the company literally rests on your shoulders, is an incredible opportunity. And I'm not sure if they do this in Hong Kong, but in the United States, every business school curriculum is a case method curriculum. So they basically throw a bunch of cases at you and you learn from cases. Well, what's better than a case is actually being involved, literally being the decision maker, being the person that's, creating the product or coming up with the ideas or being able to architect the strategy and actually execute. So I can't recommend this enough. There are so many amazing startups here in Hong Kong that I had the pleasure of meeting a few weeks ago at Boot HK, Enterproid, of course, as well. So I definitely think about it if you're not already. So first, most important thing, and this may seem obvious, but it's not. A lot of people are idea people. They come up with ideas. Oh, what if there was a restaurant recommendation app that could give me better restaurants that I could find? Or what if there was a better way to park my car in a busy Hong Kong street? So those are all great, and ideas are wonderful. But at the end of the day, starting a company is really hard. It's a long slog. The average time it takes to bring a company from idea to some sort of an exit scenario is about 8 years. So if you're going to come up with an idea, or if you're going to work for an awesome startup, do it in an area that you're passionate about. I'm personally very passionate about the education space. So do something that you would be comfortable doing, that you would love doing, even if you didn't get paid for it for the next 8 or so years. I think that's the time frame you should think about it. Don't think that just because you watch, The Social Network, or you watch, any of the stuff online, that, oh, in 18 months I'm going to sell my wonderful little app and I'm going to make a ton of money. It doesn't work that way. Just because it's in TechCrunch doesn't mean that, it's very easy to do. So that's that. Also, really important, and this is more of a personal plea because I am an idealist, do something that will positively impact the world. I can't tell you the number of companies I've seen that are restaurant recommendation apps, or that are doing daily deals for dogs, or doing, special kinds of e-commerce, and those are all totally fine, and I mean no disrespect to the entrepreneurs who are doing startups in those realms. But personally, I feel that if you are going to try and build a big company and spend the next 8 years of your life doing something, do something that can really positively affect the world. So there are huge problems in education, in health, in clean water, in all sorts of things, and I'm sure many of you are aware in other parts of China, there are many things that I am not aware of. So there are huge opportunities. And I think this is a total side point. But in the US, there's a lot of entrepreneurship, and people are building companies for the US because there's so many people in the US. There's 300 million people in the US. No, it doesn't sound like a lot to you. So there's a huge opportunity to build just for the US market, and therefore many people don't even think about international markets till later. Whereas in Europe, there's only maybe 30, 40 million people per each country, and therefore you have to think about internationalization. You guys have 1.8 billion, I believe, people in all of China, something similar to that. So there's huge opportunities to build incredible things for China, not just, copies of stuff that are being built elsewhere. So food for thought. Okay, other important point. Ideas mean absolutely nothing. And what I mean by this is a few things. Number one, don't be afraid to share your ideas. The best ideas you will come up with are not the initial thing that pops up in your mind. It's what happens when two of you collaborate, because all of you are clearly extremely bright people. So two of you are going to be sitting in a room, and you're going to have this idea about this new way to do clean drinking water in developing countries. And your friend next to you is going to be like, holy shit, I thought of this incredible, you can edit that out, I thought about this incredible other way to allow people, or maybe we can apply that idea to food or some other different space. So don't be afraid to share your idea. No one is going to share your idea, to steal your idea. And this was actually when I was a freshman in college, my first year in college. I had this idea for a members club in New York. And I told the professor about it, and I asked him, I'm a little worried. I don't want to tell people about my idea because I think they're going to steal it. And he said to me two things. Number one, the moment you come up with an idea, 50,000 other people have that exact same idea, right? It's only a matter of who actually executes on it. And number two is, what you don't realize is your idea is your baby, right? It's like the most precious thing you ever come up with. So that's why you want to guard it, right? But the thing is, everyone else has their own baby. They think your baby's ugly, and they think their baby is beautiful. So bear that in mind. People aren't just going to come across and take your idea and go off and run with it. I mean, I'm sure there are people that will do that, but it is so rare. And the benefits of sharing your idea and cross-pollinating your ideas far outweighs the probability that someone's going to take your idea. And the second part of this is, execution is what matters. Anyone can come up with an idea. And what frustrates me to no end is when I'm sitting with someone in conversation and I tell them about some startup I saw the other day, or I tell them about, we're talking about Facebook or something. They're like, yeah, I had that idea, back in 2004 or whatever it was. So what? You didn't do anything with it. You didn't, go out and you didn't build it, and you didn't work your butt off to actually make sure that it was going to be successful. So execution matters, ideas don't matter. And each person's execution on an individual idea will be different. which is why, again, there's no harm in sharing your ideas. So, okay, also really important. If you are going to come up with an idea in a space, do it in a space that either you've already had experience in or that you can easily have experience in. So right now, a lot of people talk about the fact that there's this whole, in the United States, is a huge baby boomer population. And if any of you aren't familiar, it's during the period right after World War II, there were a lot of births. And so those people now, because there were all sorts of government incentives to have kids, so those people now are all in their late 50s, early 60s. And so what that means is there's a huge opportunity to build products and services for that older kind of that generation that is now becoming older and that is actually computer literate. The problem is that none of you are in your late 50s or early 60s. So while you can come up with an idea for, oh, it would be so cool if there was a app to help, older people find other older people or something like that, you don't intimately understand what they're thinking, what their mentality is, what they're looking for. So for you to build to a different demographic, some other people, is totally ridiculous. And it's not impossible, but it will take you twice, if not 3 times or more as long to figure out what the market looks like, what the product actually should be. You need to be the one experiencing the pain yourself. So when we look at investing in companies, so a great example is Enterproid, the company that I've now recently joined. So Enterproid's created this really cool technology that basically allows you to have a work and a personal phone on the same device. So you literally just double tap the home screen, it switches to your work phone, and then back to your personal phone. So when the founders came to us to pitch us the idea, there were 3 founders. 2 of them are Stanford University graduates. One of them is a Stanford PhD it's a Stanford PhD. He taught Stanford computer science. So they're clearly very, very bright. But more importantly, 2 of them had ran mobile for Morgan Stanley and then subsequently for Viacom. So they literally understood not only the technical aspect of building this product, but they understood exactly what the customers want. They knew what the pain was. They knew how to solve it. They knew who the partners were, who the competition was. So when I handed them that check, that investment check, they didn't take the first year to figure out all that stuff. They went right at it and were able to grow very quickly. And now they've raised subsequent funding from Google Ventures and a bunch of other great venture capital firms. So really important to experience the pain yourself. Okay, also really important. It may seem cool, or may seem like a great idea you come up with a small little idea and build a little app, launch it into the market, get traction, and maybe sell it for a few bucks. That's awesome. You should definitely do it. It's always fun to be releasing ideas. But this talk, at least what I want to focus on, is building really big companies, right? Building things that will hopefully change the world. What venture capitalists or any investor wants to see is that what you're building is something that's sufficiently complex or difficult or solving a big enough problem that someone else can't copy you, a week later, right? Because all you've done is create a recommendation engine that pulls in your Facebook, Twitter, and LinkedIn data, and anyone else can use the same APIs to pull in the same amount of data, right? So generally, you want to produce something that's simple for the end user, and I'm all about simplicity. But simplicity for the end user doesn't mean that it's necessarily simple to build. In fact, I think there's an inverse relationship between the simplicity of what the end user sees and the processes behind it that actually make it work. The classic cliche example right now is Square. Right? What they've produced is a beautiful user experience, which is very, very complex mechanically, financially, on all sorts of levels, but they do it really well. So build something that is not going to, that's going to take you, months to build. And not because it's unnecessarily complex, but simply use that time period as a metric for how difficult of a problem you're actually solving. But at the end of the day, the product that you end up with should be beautifully simple. It should solve a very, very specific pain point for an individual. If you're trying to solve multiple things with the same product, you will fail. Because in the beginning, you need one thing that people can lash onto, one thing that will get people to think of you, that will get them to, run after you and knock down your door just to hand you $1 or a Hong Kong dollar to purchase, whatever it is you're selling. And if you've got multiple tiers of pricing and multiple products and services and all sorts of other add-ons, people aren't going to quickly and easily understand what it is. Especially now when you talk about releasing a mobile app through these app markets, there's so much noise. There's so much, there's so many apps out there that if you want to get yourself noticed, you have to do one thing and do it really, really well and stay focused. So again, a plug for Enterproid. So this is also really important. I made a big mistake. I've made this mistake multiple times, actually. When I was an undergraduate and before, I did a number of startups, most of which were, or a lot of which were failures. And the biggest mistake I would make is I would come up with an idea, and I'd be like, oh, this is such an exciting idea, I'm just going to do it. And on one hand, that was great because I learned a ton. I made some incredible, connections. I, learned a lot about business, about design, and all that. But at the end of the day, they didn't work out because there were a lot of things I was missing. I was missing an understanding of how to work efficiently with other people. I was missing an understanding of how to build a beautiful, simple product, how to communicate with developers and a development team, how to grow a company, There's many, many different things you can learn, and I encourage people, and the next slide is encouraging people to start now and work on your idea now. But just because you can and now you have the tools to build an app very quickly and to get things out to market very quickly doesn't mean you should skip that very crucial step of spending some small period of time. Maybe it's a few months, maybe it's a year, maybe it's 2, learning from incredible people. Find really, really bright, awesome, passionate people that are doing something really, really cool in an area that you really care about and help them be successful. And in doing that, you will learn a ridiculous amount, which will only benefit your own project later. So yeah, start now. There's, I don't know what your backgrounds are in terms of skills, whether you guys are more focused on, whether you can code or whether you can, you're awesome at Adobe Illustrator or other more advanced things. But no matter what your level is, there are so many amazing tools nowadays to allow you to start working on your idea now. And what I recommend is find a great company, to hopefully a startup to work for, build a great product for them, but on the side, spend every night spending an hour or 2 or a weekend working on your own idea. And I guarantee you, taking that long period of time to allow that idea to, to kind of simmer and expand is incredibly, incredibly valuable. So, if you are a coder and you don't know much about design, or if you're a designer as well, I love Keynote, for example. I don't know how many of you use Keynote for prototyping, but there's a great website, I believe it's like keynotekungfu.com or something like that, where they have all these different iOS, buttons and drop downs and all that kind of stuff, and you can literally prototype in minutes instead of going through Photoshop and Illustrator and coming up with something pixel perfect, or going straight to Java or Objective-C and building something directly. So you can prototype quickly, you can show the prototypes to your friends on your iPhone, on your Android, and get their ideas, their input on your idea, and take time to think through it. Think through what is the first experience the user has when they come to your site or come to your app. What's the first, what is the purchasing experience like? What is how do you create viral hooks to allow them to share what they're doing on your app with their friends to get more adoption? So there's a lot of things you can do before you ever get to building a real product, and I think that's really the best way to do it. So if you have an idea, start now and just start kind of manipulating it and working on something that's a little more, you know, a little more tangible than just a piece of paper. Okay, also really important, and this may piss off the instructors a bit, so in New York right now, there are a lot of incubators and accelerator programs. In fact, we're an investor in Techstars in New York. I don't know if you're familiar with it. Generally, and there are a lot of like weekend hackathons and, you know, all these different programs to get developers together, to get designers together and come up with an idea and then commercialize it. These things are great. They encourage creativity. They come up with some really cool stuff. But you should be very careful, because if you are going to spend the next 8 years of your life building something, and again, that is the metric you should use whenever you start something, be very careful that the people you are working with are people you like working with, that they are people you can, you know, travel with, and people that you can sit next to for 12, 14, 20 hours a day, every single day. You know, so I was in Singapore last weekend, and I spent the last few weeks traveling with a friend who now was in college with me and now works with us at Enterproid. And I've had some pretty terrible travel buddies. And this friend of mine, you know, we went around to these like super budget, you know, places, hostels or whatnot in these countries. And, you know, sometimes they didn't have 2 separate beds. They have 1 bed. You got to deal with it. And had it been anyone else, we probably would not have made it out of that trip. But we had a great relationship, and we just sucked it up, and it was cool. You want someone like that. You want someone who you could sleep in the same bed with and be cool with. That's really important. So, you know, no offense if anyone's already paired off into groups and it's not exactly working out, but if in the future, you know, when you try and build something, bear that in mind. Whoops. Cool. So the next few things I'm going to talk about are more related to when you have your idea, how do you raise capital for it? I know that the investment scene is very different here than it is in New York. I hope these principles can apply. I think they apply generally. The venture firm that we launched was a family office, and I know a lot of the capital here comes from families. So I think it's pretty universal, but feel free to jump in and tell me I'm wrong. First of all, don't raise venture capital or take money from anyone if possible. Very contradictory given the fact that I was a venture capitalist. But venture capital or taking money from anyone that gives them equity in your company is the most expensive money you can take. There are plenty of ways generally to raise capital, like self-financing your own growth, charging for some initial product and getting people to give you dollars, or perhaps borrowing money from the bank, that allows you to grow your company without being responsible to other people. There's a lot of responsibility involved when you take money from someone, and it shouldn't be taken lightly. Venture capital specifically is the best, I think, analogy I've been given is it's literally like pouring rocket fuel onto your company. So wherever you are, at whatever stage you are in your company, whether it's just an idea or whether you got one product out, it's literally like you took rocket fuel, poured it on there, and it will just shoot off, meaning you will start having to move very quickly. You are responsible to someone. They will expect you to hit milestones. So you need to make you need to make sure that when you take capital from someone, even if it's a bank or some other entity, that you are ready to take capital, that you know what you're going to spend the money on, that you're sure that there's no other way to progress further along before you take capital, because there's no turning back once you do. Here I gather, so I don't know how familiar you guys are with angel investors versus venture capitalists. Angel investors is a term used to describe individuals who invest their own money, generally non-professionally. So just wealthy people. It could be a doctor or a lawyer who has, you know, some extra cash in the bank and decides to invest in his friend's venture. Whereas venture capitalists are individuals who invest money for someone else. in the United States, most venture capitalists invest money on behalf of pension funds or university funds or, you know, all sorts of other entities, government entities sometimes. So there are a lot of debates online as to whether you should take money from angels or VCs and when and how, and I can get into a bunch of that stuff if anyone's interested. But the most important thing to remember is the only thing that matters is that you take money from people that you really, really like. Because it's just like when you partner with someone to do your own, you know, to do your startup. You will be married to this investor for the next 8 years. So make sure it's someone who you are willing to take their phone call every day, who you can deal with when they get upset at you. I would not recommend the mafia because that would probably be bad. You know, so make sure that it's someone that you get along with that can help you build your company, that has insight into the space. Sometimes you don't have the luxury to get someone like that, but if you don't, just make sure it's someone that you're not going to get in constant fights with, because that sucks. So this is also really important. There was this trend for the last few years to just build a company, get it out there, get a lot of traction, and then try and raise venture capital. I imagine it's probably very different here because there's less capital available in Hong Kong. But the best way to finance the growth of your company, the best way to prove to people that you have a good idea is to show that people will pay for it. That is the best metric. Because if you come up to me and you say to me, I've created this crazy dog washing app, right? That, you know, I don't know what it does, but in the first 2 weeks, 100,000 people went online and paid me $5 for it. You've got something awesome on your hands. It doesn't really matter what it is. You can show someone that you come up with this crazy idea, and regardless of how crazy it is, people care about it. So the most important thing I tell entrepreneurs is, well, maybe not the most important, but an important thing I tell entrepreneurs is you really should think right away, the moment you come up with an idea, about how you're going to monetize it. What will people pay for? Is the pain that you are solving for strong enough such that someone will take out their pocketbook and hand you money? And that's a really good, I think, metric to go by. Because if you're just, you know, helping people, you know, I don't know, find their way down the street, and that's not really important because there are 20 other apps that do it for free, then the pain you're solving is not great enough. You're not working on a hard enough problem. So you need to continue to try and work on, you know, things that solve greater pains for people such that they're going to be knocking down your door to hand you money. This is also a very complex topic that I'm happy to get into afterwards if anyone's really interested in terms of valuations and how much you raise and how do you raise it. But don't take more money than you need because you're responsible for every extra dollar you take. Don't work too hard to optimize the value that you raise that money at. I don't know what it is here, but in New York and generally across the United States, you should assume the rule of thumb is that you should expect every time you raise capital to give up 25 to 33% of your company. So no matter whether it's your first, you know, $1 million you raise or your, you know, third time raising, you're raising $10 million, generally companies give up 25 to a third to a quarter of their company every single time they raise capital. So bear that in mind. If you try and over-optimize the situation and go back and forth with investors and negotiate a deal where you're only giving up 15% or something like that, you're going to have a much harder time raising the next round of capital. What most entrepreneurs fail to realize is the hardest money to raise is not the first capital, because the first time you raise money, you're selling hopes and dreams, right? Nothing exists. So literally you're saying, hey, I got this great idea, it's going to get 1 million users, you know, in the next few weeks, it's going to revolutionize the world, right? And they're like, wow, okay, this, you know, bright person, they went to Hong Kong Polytechnic, they know what they're talking about, so yeah, I'll give them $1 million. But once you raise that money, 12 months later, and that generally is the time period, you want to plan to raise capital probably every 12 to 18 months, they're going to say, okay, well, what have you accomplished? And if your app hasn't gotten 1 million users and revolutionized the world and done all this amazing stuff, you are not going to be able to raise money again. So if you try and optimize that first capital raise too much, and perhaps take money from people you don't like instead of taking, giving up more of your company to take money from people you do like, you are going to get screwed in the near future. This is one to think about. So starting a business is obviously very risky. Though I think, it's arguable how correct the statistics are that 80% of companies fail. I'm not really sure that's actually that accurate. And it depends what type of business you're talking about. But the point is that when you start something, inherently you are creating something new in the world, right? And getting traction and adoption, getting people to pay for it, is really, really hard. So try to minimize the amount of complexity. And I know this is slightly counter to what I was saying earlier in terms of build something difficult, but try to reduce the amount of complexity in what you build. And what I mean by that is, don't immediately try and support 10 different languages. Don't immediately try and sell this thing in 2 different markets. Focus on one market, focus on one demographic, focus on one pain point. There are plenty of red flags I can give you for venture capitalists, but for example, one common one is building a marketplace, right? What's really difficult about building a marketplace is you have to build both sides, right? So how do you get the buyers and the sellers? So let's say you're building an Airbnb for China, which apparently the Samwer brothers have just come out with. You have to get people to both list their apartments, and you have to get people to want to get apartments and to trust your site and the apartments on your site. Both of those are potentially two totally different demographics. People who are chill enough and traveling and want to rent out their place, and people who are perhaps working long stints in an area and want to rent something. So building a product that works for both of those demographics in both of those places is very, very hard. So you can do it, and you definitely shouldn't avoid doing it, but you need to figure out how to minimize as much risk as possible. So perhaps what you can do is you can create some sort of a benefit for people listing their apartment, even if they don't rent it out. Maybe you give them this beautiful splash page that they can show their friends how cool their apartment is. And therefore, regardless of whether someone actually rents it in the first 6 months, they're happy enough for the first 6 months with the fact that you've given them this beautiful landing page. And then, while they're simmering in that glory of that landing page, you can go over and find the buyers and get them on the site. So just really think about how to minimize as much external risk as possible, and to build the smallest component you can first, and then gradually build it up over time. Okay, team and traction. So when you raise capital, there are a lot of things that investors will ask you for. They'll generally ask you for financial models. They'll ask you about the market size. They'll ask you about, who knows. These are the only 2 things they actually care about. If you have a great team, and you have great traction, the probability of you getting funded is absolutely excellent. And if you only have one of the 2, but they're excellent, it's still a great probability of getting fundraising. So let me give you a concrete example. If you come into my office and you're Mark Zuckerberg, and you tell me, I'm going to open up a pig farm, will you invest in me? I would probably invest. I don't even care if it's a pig farm, because Mark Zuckerberg has proven that he has been able to build an incredibly huge company very successfully. And in fact, a great example is, I don't know if you guys read the article that Sequoia had funded this grilled cheese startup called, I think, Melt, founded by the guy who did flip cameras. So regardless of the fact that it's a new space, and this guy, I think, comes from a technology background, they're willing to invest a large amount of money in him to open up retail grilled cheese shops. And the reason is because he's proven he can do it. He can take an idea and execute. So when you pitch someone, pitch them making sure that you have 2 things. Number 1, the experience, understanding the pain point, that you've lived and breathed the problem for at least 1, if not multiple years, like I mentioned before. And number 2, that you've got people on your team that can execute, that have amazing skill sets. And hey, if you've done a startup before and it's been successful and you've sold it, all the better. Or if you can find someone like that to put on your team. And in terms of traction, if you walk in my door and you tell me, you know, I was able to get 1 million users in a week, I probably wouldn't care what you're building, right? I'd be like, oh, that's awesome, done, we're investing. Because you've been able to prove that you have solved a pain point that a lot of people care about, and preferably that they've been able to pay you money for. So you'll notice that idea is nowhere in here. Idea is very important, but traction is a sign that you had an idea that actually solved a real problem that people actually cared about and that they were willing to pay you for. So, and the reason I mention these, and I'll walk through a sample pitch deck in a second, but the reason I mention these is because when you talk to investors, these are the first two things you should be talking about. You should talk about the team, you should emphasize it, you should have pictures of the team, and you should talk about what you've actually done in the space. You should not raise capital until you have already been able to put your product in the market and get some user feedback. It's a little different when you talk about like heavy science stuff, like that takes a lot of R&D, and you know, there are some investors that are willing to invest without that type of proof, and power to them. But for most of the stuff that you're going to build, you should really try and get it into the market first and see how customers react to it. Okay, so this is also really important. Investors are not rational. You have to be crazy to invest in a startup company. It is very risky, right? So the investors that you pitch, you know, are either one of two things. They're either crazy, or they're just having fun, or it's not their money and they don't really care. But you know, it's probably one of those two things, right? So you need to appeal to those emotions. When you talk to investors, you need to make it clear to them that you would be a fun person to hang out with for the next 8 years, that you're working on something that is so worthwhile, especially if it's not an institutional investor, if it's an individual person, a family friend, or whatever it is. Though I wouldn't recommend raising money from family friends, but you need to show them and pull at their heartstrings, you know, at their emotion, not necessarily just hand them some financial model and say, hey, here's how much money you're going to make 3 years down the line. Because if that was the case, they could just invest in a bond or some sort of a stock. So pitch to the heart, and the best pitch is a demo. When the Enterproid guys walked into my office, let's see, I have it over here. So literally, this was the pitch. I didn't even see their pitch deck. They came over to me and they pulled out their phone and they said, hey, so here's my personal phone, all my personal apps. And then I just double tap on the home screen, and there we go. I put in my work password. And now I'm in a totally separate and secure work environment with all my work apps. My work email, my work messaging, and that's it. That was the whole demo. Incredible, right? Like, to be able to so simply create a seamless environment where I just double tap and switch back and forward is a beautiful demo. So when you talk to an investor, or anyone really, you should immediately show them a demo, show them the product, show them what they will be investing in. And as I mentioned before, you don't even have to build the whole thing. You can build a little keynote mock-up, export it to a PDF, put it onto your iPhone or Android, and when you show someone, just literally show them the mock-ups that you've done. This is how I'm thinking about it. This is how I think the interactions will be. It's really a great method for explaining what you're talking about. So this is also really important. Making a pitch deck. A deck is generally a landscape view, 10 slides, 10 to 12 slides, like a PowerPoint presentation essentially. The less text, the better. That explains to the investor or anyone the most important parts of your business. And the reason this is important is twofold. Number one is investors don't read. So, or most people don't read at all, right? And I'm sure, I think you guys are in a design program, so you'll appreciate this, which is that the best way to appeal to people is through pictures, right? So show them what you're talking about. If you send me a 50-page business plan, I will not read it. I probably won't even read the first sentence of it. Even if you send me a one-page executive summary with paragraphs of text, I won't read it. Show me something that I can emotionally connect to, right? So just no more than 10 to 12 slides, if not less. The best pitch deck I ever got, I think, was 6 slides. And I'll show you what to include in a second. But that's the way you should think about it. And the second important reason to have this is decks are the communication medium for investors. So if you talk to one investor and he likes your idea, he will forward your deck onto another investor. What a lot of entrepreneurs don't realize is, as investors, the currency of venture capital is good startups. So if someone pitches me a very cool company, it's in my best interest to forward that on to my close venture capital friends so that they know that I'm getting good deal flow, right? And that I'm sharing good deal flow with them. It's kind of a courtesy to them. So you should make it so easy for them to share your thing with other investors so that they can get their other, investor friends or family members involved in your company and excited about it, instead of having to try and remember that one awesome line you said and recite it to them, afterwards. So this is the perfect deck. A lot of investors have their own notion for what it is, but in general, these are the 10 things, the 10 topics that you need to cover. If you have covered these 10 things, you are good to go. I'm sure they'll ask you about other stuff, but this is the stuff that they actually care about. And I'll go through examples of each of these. So, first of all, the intro. The first slide should quickly and easily explain the opportunity. Again, this deck, if you have more than a line of text on any page of this deck, besides the team slide, there's too much text. They won't read it. So Yipit is a portfolio company of ours. They do daily deal aggregation. They did it way early in this whole daily deal trend. So immediately on the first page, I understand exactly what the problem, the solution, and how big the market is in one simple picture, right? So many group buying services. They're clearly very popular because there are so many of them and it's growing very quickly. Local consumers don't know what to do. They're getting too many emails in their inbox. Yipit's here in the middle, just like a kayak for daily deals. Beautiful, beautiful, simple. Another example from one of our portfolio companies, Indiegogo. They do crowdfunding, just like I'm sure you've heard of Kickstarter as well. So I don't like the fact that it's text, but it's fine. At least it's only one line of text, right? It's a funding platform for ideas. Simple. I understand what I'm getting into with this deck. I don't have to search in this deck and hear tons of slides on what the opportunity may be before I actually get to what they're actually doing. Very important. The team. Put your picture up there. Again, people are investing in you, not in this ephemeral idea. They want to see who they are getting into bed with, right? They want to feel like they can connect to you. Preferably, you should also put one or two lines. One thing I don't like about this is they don't say what their background is. They kind of have it vaguely on the side. But put one or two lines that explain why I should care. Why should I listen to you? It's really important that this slide is second in the deck, because if you went to Hong Kong Polytechnic and you did a degree in, and you focused on, I don't know, human-computer interaction, and you're doing a startup that's like revolutionizing human-computer interaction, tell me that, make me know that you are the world-renowned expert in human-computer interaction so that I actually want to pay attention to you. Second important slide, traction, right? Again, team and traction, the two most important things. Show me some sort of a graph that goes up and to the right. Investors like those. But importantly, tell me why, right? And just show me something that shows that you're not just growing linearly, that it's not a straight line, that I'm getting in right at the inflection point, right as this company is taking off, that this is the reason I need to hop on board right now and invest tomorrow. Because if I don't invest, the company's going to take off without me, right? So make it very clear, again, why they should pay attention to you, why right now is the time to care. And of course, you can't do that unless you've already launched a product into the market, so launch the product first. Problem, again, this is slightly redundant, but it explains easily what the issue is, again for Yipit. Solution, really important, show the product. Again, connect emotionally with them. you need to show them what they're investing in. If you don't, I'm like, okay, great, they've got it, they understand the problem, the market, all this kind of stuff, but where is my money going? Is it just going into the ether and flying away, or am I actually investing in something real? So show me something that I'm actually investing in. Again, Indiegogo with a product page to actually show me. Have something that explains the market. Investors, this may sound really weird, but investors generally have to invest in at least a $10 billion market. And the reason for this is, though it sounds kind of backwards, there are a number of reasons for this, but generally investors believe that the idea you come to them with will not be the idea that you end up with, right? I think PayPal pivoted, at least 5 different times before they actually got to online payments, right? I think they were initially a mobile security company, then they realized they were too early, and they switched to mobile payments, and they realized they were too early for that, and they switched to online payments, didn't really work, and they switched to online payments through eBay, which ended up working. Every time you pivot and change your model, your market shrinks, right? Because you become more focused, and you realize your solution is actually only valid for a smaller and smaller segment of the market. So if you start off building something for a $10 million market, right, and you start building a product for dog walkers in Kowloon, right, investors aren't going to care because it's not going to become a very big company. Unless you tell them that, well, dog walkers in Kowloon are really just our wedge into the market, another kind of industry jargon. It's just our way of getting into the market, but really we want to attack the global market of dog walkers, and that actually happens to be a $100 billion market for some odd reason, right? But make it clear to investors that you've done your homework, that not only do you have an idea, but you've thought about what space you're selling it into. Who will buy it? Why is there a large number of people that will buy in that space? And also show that it's a growing space, not shrinking. Another way to do market, more visual, much better, do visual things. Strategy, fairly straightforward. Show me that you've thought through what you're going to do. Definitely for the next 12 months, month by month, but especially for the next few years. Where does this go? How do you take it from dog walkers in Kowloon to, the global dog walking market? How do you attack it? What social media strategies do you use? How do you sell the product? Who's going to buy it? What partnerships are you going to do? The more information you can give me, the more I think that you actually know what you're talking about. Again, here's another way of doing strategy, much more text-based, make it visual. Competition. Many people leave the competition slide out of their deck because they think that investors are too stupid to realize that there are competitors no matter what you're doing. There are competitors no matter what you are doing. And what I mean by competitor, and this is really important, is not necessarily someone who's already doing what you're doing. Not another dog walking service in Kowloon, but someone whose product is the next best alternative to solving the pain point that you are solving. So a classic example is a good friend of mine in New York is building a website called Loverly. It's a scrapbooking site for weddings, and they do all sorts of other cool stuff too. So when she first came to me to pitch her company, she showed me her competition slide, and on it she had the knot.com, which in the States at least is a wedding planning website. And she said that was a competitor. But in reality, the Knot isn't a competitor. The competitor is a site like Pinterest, where you can scrapbook stuff. Even though it's not built for weddings, people on Pinterest can use Pinterest for weddings. So Pinterest is not in the wedding space at all, but it is the next best alternative to solving the pain that she was solving. So think through this really hard, spend a lot of time on it, and put it in the deck, because it will make the people you are communicating with know that you've already thought through this. That when they sit down with you, they're not going to tell you, oh, well, have you thought about this company and this company? And what do you mean there's no competition? There's always, always competition. There's always someone vying for the brain share of your customer. Business plan. this is, again, really important. Tell me how you're going to make money right away. It doesn't matter if this doesn't pan out at all, that you're never able to charge for this, and in fact your revenue model is something totally different. Show me that you've thought through it. That at least the methods that you've come up with to make money make sense, right? That people would pay for it in a large and growing market. What bothers VCs to no end, this line right here, that we are going to, and advertising, which may not be here. Every startup that's pitched me in the last year or two has said, oh, well, we're going to make money off the data from our service, right? We'll do all this kind of cool aggregation stuff, or do this marketplace for this, and we'll take the data and then we'll sell it to someone else. It works in very few occasions for a small amount of money, but generally that's not what you should found your business on. Try and find a business model that is making money off of the core service that you are providing, which solves a specific pain point. Don't try and make money off of something that's tangential to your business, or by putting ads on your site. Ads is another thing that VCs can't stand, because yeah, you can make money off ads, but very, very little. To make any money off ads, this is a good food for thought, is you need to have on your site at least 5 million uniques per month to get major advertisers even remotely interested in your company. If you already have 5 million uniques on your site, then you're probably not pitching me, right? So don't use that as a crutch that you're going to make money off advertising or off data. Find a business model where if your thesis is right, if your product actually solves the pain point that you want it to solve, that people will pay you for it. Because if they won't pay you for it, then your solution isn't good enough. Same thing, more business model stuff. And finally, tell an investor what you want, how much you are raising, how long it will last you, and what you're going to spend it on. Really, really important. Every investor worth his salt will ask you how long the money will last you. You should raise money that will last you at least 18 months. And the reason for this is, it takes you, rule of thumb, it takes you at least 12 months to hit milestones, serious milestones. And then it will take you another 6 months to raise venture capital. It takes a long time to raise capital, as some of you may be aware. So leave yourself enough room to be able to grow the business and to be able to prove that you've done something before you have to raise money again. So if you're going to raise 500K, make sure that your burn rate is such that you're keeping it lean enough that it will last at least 18 months, if not much longer. Another example of what they're going to use it for, how much. This is also really important, by the way. If you can tell investors that money is already committed, that is really key, because no one wants to be the first person in. So if you can communicate to them, look, you're not coming in alone, I already have other interests, that's a great motivating factor. So again, your deck should only be 10 slides or less, right? And the beauty of this is twofold. Number one is they'll actually read it. But number two is that if you have all sorts of other stuff, market data or financial models or anything, it's a great excuse to reach out to them again. So what you can do is you send them your deck and say, hey, great to meet with you, here's my deck, or I'm looking forward to our meeting next week, here's the deck in advance. Always send your deck in advance. And then a week later, they've forgotten about you, and they haven't responded to your email, and you say, hey, by the way, here's the rest of my information. It's a great way to reach out to them again and touch them again. Let's have a follow-up call, once you've reviewed this or something like that. So keep some sort of addendum that you send separately. So this seems very obvious. Yeah, of course I'll ask for feedback when I pitch someone. But here's exactly what normally happens. Someone will pitch me, or any investor, and a few days later, they'll get a response from the investor, a 2-sentence response that says, hey, thanks so much for spending the time. It's not a fit for our firm. Keep us posted. right? The reason they don't give an explanation is because what generally happens is, and I learned this the hard way in my first 2 years, is when I started out in venture capital, I would write like a page response to people. I would give all these reasons why I didn't think it was a good idea, which were going on in my head. But remember, everyone's company, everyone's idea is their baby, right? So immediately the person responds like, oh, but you totally misunderstood this, and you're totally wrong here, and all this is off, and this, and this are the reasons why it will be successful. So what happens is early on VCs learn this, and therefore afterwards they never give answers. They just give this ambiguous, it's not a fit for our firm, because entrepreneurs generally can't handle feedback. So the best thing to do is after a pitch, ask for honest feedback about specific areas of the business. What did you think about this? What did you think about this? And don't respond. Don't tell them why they're wrong, why they weren't listening to you, why they weren't paying attention, why all that is the case. Write it down, and again, use it as another opportunity to follow up later in a very respectful manner, saying, hey, I thought about what you said. You were so right. Here's a few additional thoughts that I had upon further, considering your feedback or something like that. That's the best way to respond. So investors, again, are very lazy. And you could take advantage of that, meaning if ahead of time you've researched and you've figured out who the investors are you want to talk to. So again, this is probably much easier in New York than it is in Hong Kong, because in New York there are an abundance of investors and they're all online and they're blogging and tweeting and whatnot. But I'm sure you can do something very similar here, which is come up with a hit list of investors you want to talk to, specific partners at specific firms. The strategy is, after your pitch with an investor, hopefully it went well, you ask them, hey, really appreciate your time. Is there any way you can, I know you're close with this person because I see that they follow you on Twitter or you follow them on Twitter. Would you mind making an introduction to me? I've been following them forever and it would really mean a lot to me. Something like that. Because what generally happens is an entrepreneur will say after the pitch, hey, if there's any other investors you know, could you please, introduce me? That doesn't work because I have a Rolodex of, let's say, 100 investors. All of them are in different spaces. I'm not going to go through my address book and look through each one, figure out which ones are very specific to dog walking or something like that, and then make introductions to those 5 investors, follow up with them. It's just too much work. So take the work off their plate. Do the homework ahead of time. Come to them with a list and ask them very specifically for introductions to specific people. May or may not matter to you guys, but if you do talk to a venture capitalist, these are the things you should ask them. And they will be surprised and impressed that you know enough about their industry to ask these things. Very quickly, how big is their fund? Meaning, how much capital do they have to invest? How much dry powder is left? Dry powder means how much money is left uninvested in their fund. So if they have a $100 million fund and they've already been around for 3 years, they may have already invested 70 million of it. So they only have 30 million left. And if you ask them, not on there, but if you ask them how many investments they make a year, which is a perfectly valid question to ask them, you can back into how much money they invest in each fund and how many investments they have left to make in their fund, right? So, and you can use this to your advantage. So for example, I actually had a VC that's a very close friend of mine, a few months ago come up to me and say, hey, have you seen any good companies lately? We have 4 months left to deploy the capital of our fund, right? So he's got like 2 million left in his fund and 4 months to spend it. So he just has to find companies. So the threshold for investment for a guy like that is much lower. And the structure may be different here, but most venture capital firms have specific time horizons. So it'll be a 10-year fund generally. They'll have the first 5 years to invest the capital and the second 5 years to harvest the investments. So if they haven't invested all that money in the first 5 years, it doesn't, it goes back to the investors. So it's their investors. So it's in their best interest to deploy all that capital. So take advantage of that and figure out how much dry powder they have left. Figure out what they look for. Figure out if they lead or they need someone else to take the lead on an investment. And this is the best one right here. Find out who they work with. Because then you can actually ask at the end of the conversation, hey, so I know you work closely with this firm. Can you make an introduction? That would be awesome. Food for thought. So this is one of the most important things I have to say, which is a lot of companies take money, even if it's only $50,000 or $100,000. And once you have money, the dynamic automatically changes. We raised a lot of capital for our for Enterproid, and immediately the dynamic changes because it has to change. Investors are investing a certain amount of money because they expect, again, it's rocket fuel, you to grow at a very fast rate. So they're giving you money to hire people, to make sales, to travel, to do all these amazing things, and you should. But be very careful because there is only one reason that companies fail, and I stole this from Paul Graham. But the only reason companies fail is because they run out of money. And what I mean by this is, I've seen, companies with what I thought were terrible ideas that turned out to be great successes. And I've seen companies with great ideas that turned out to be abysmal failures. An idea needs time to find the right market, right? It's the industry term is product market fit. Sometimes it takes 3 years for your idea to find the right market. Maybe you have this great technology for dog walkers, but you didn't immediately think so, and you thought that it was a great technology for tracking rats in a lab, right? And so you spent 2 years reaching out to labs and trying to sell your product and realizing no one's biting. And it wasn't until your crazy friend said, hey, I'd love that for my dog walking, that you all of a sudden hit product market fit and sold 1 million of them to dog walkers. So if you take capital, and even if you don't take capital, stay as lean and as nimble as you possibly can. You need to stretch the dollars that you do have as far as you possibly can until you are able to actually hit that product market fit. Because I truly don't believe that any idea cannot be successful at some point. It's just a matter of stretching it long enough to find that proper market and opportunity. Okay, so I guess that's it. So yeah, my Twitter handle, my website, in case any of you are too shy to come up with your own questions. I'm more than happy to answer questions. But yeah, I was just hoping to open it up. Are any of you working on projects? Any ideas? Anything you want to throw? Kevin, I'm going to call on you if you know. Oh, so by the way, if any, again, another pitch for our startup. We work for an awesome startup company, literally located down the street in Kowloon. It's called Enterproid. We are hiring. Please talk to Kevin, who was in this class previously, if you are interested. So yeah, that's it. Cool. Any? Questions? No? No questions? Come on. Okay.
Do you VCs ever invest in competing companies that like try to fight each other, actually do the same thing?
Yeah, so it's actually that's a really good question. And in fact, it's kind of happened in some of our portfolio companies. So the issue is, so generally, investors try not to, right? Because it's in your best interest to spend your time and energy and resources making your company successful. And if you have two companies that are doing the same thing, you just inherently can't do that, and you're just shooting yourself. The problem is that what happens, and I guess the best way of explaining this is, I had a company pitch me 2 weeks ago, and they had a really interesting idea, but no one had become successful in their space. So there were 5 companies who had built apps for their space. Let's just say it was people meeting other people in random places, right? So you come up with an app and it sucks in all your social networks, and you're in a convention or you're in the airport, you pull up the app and you could see who around you is similar to you. Great idea, right? Problem is, no one has actually been successful, and I can off the top of my head name 5 apps that are all doing that. So while it's dangerous to compete in a space where there is a large company that's been successful before, competing in a space where no one has been successful is also very dangerous, because what that means is if any of them have raised capital, again, they're shooting off with that rocket fuel, right? They have to continue to pivot or change their business model until they find product market fit. right? Until they find that dog walker opportunity. So what happens often is a VC may actually invest in two totally different companies that end up pivoting into the same space. And I think a great example is, I don't know if you guys are familiar with Andreessen Horowitz, which is a famous firm in San Francisco, but they had invested in a company called Bourbon, which pivoted into Instagram, right? But before the pivot happened, they invested in a company called PickPlease, which is also a photo sharing app. So Bourbon changes to Instagram, and all of a sudden in their portfolio, they had two companies that were literally doing the exact same thing. So it's a huge problem. It happens all the time. Investors, at least right now, because it's so easy now to change your business model and to launch another app in the market. So investors try to avoid it. It's in their best interest to avoid it, but inherently it just happens. So if you are building a product in a space where there are a few other companies who have not been successful, be aware that at some point they will probably try your model, and in fact they probably already have. In which case you should probably think about what you're doing ahead of time, because they've probably tried it. So, good question. Anyone else? No? No? Okay.
Let me ask a couple of questions.
Yeah, sure.
Thank you. It was a great presentation.
Thanks.
Oh, yes, I even have notes. Right? One thing that you moved through very quickly on your slides was the idea of lead or follow. Can you just give them a little bit more of an idea of what you mean there?
Whether investors lead or follow. Yeah, so some investors are simply more cavalier than others, or simply more risk takers than others. A lot of people who invest their own money take a lot bigger risks than the people who invest institutional money, because they are responsible, they have a fiduciary duty of that capital. So you should be aware when you talk to investors to understand their pattern of investment. And in fact, going along with that do your homework slide, the best thing to do before you pitch a VC is look at their portfolio. Look at what they've invested in the past. And if a VC doesn't have their portfolio online, they are a shit VC, generally speaking. Because it means they're either ashamed of their companies or, they're just shady. So look at their portfolio, ask them in your meeting, what other companies have you invested in? What spaces do you like? And figuring out what companies they've invested in and what those investment rounds have looked like will give you an immense amount of information about what type of investor they are. Because if you talk to an investor who only follows, who doesn't lead deals, so lead or follow means lead a deal or follow in a deal. So to back up for a second, when you raise capital for your investment, generally you raise from more than one person, right? So you'll take 100,000 from this person and 500,000 from this person and 100,000 from this person and 20 from that family friend. So it's called syndicating the deal, bringing together multiple investors, right? So some investors will never lead a deal. So if they are the first investor you are talking to, you are wasting your time, because they will not invest. They only follow. So you have to make sure the first people you should be spending all your time on are the people that lead deals. Granted, another point which I didn't talk about is the earlier you talk to investors, the better. Investors, there was a great article, I don't know if any of you read the blog, bothsidesofthetable.com, by a venture capitalist in LA named Mark Suster. But he wrote a great article, I think titled, Investors Invest in Lines, Not Dots. Meaning, you come to an investor and you say, hey, I'm raising money for this, we're closing the round tomorrow, I need your money tomorrow. They're never going to invest. They want to get to know you. They want to become comfortable with you. So the earlier you meet an investor and start sharing your idea with them, you should share it in a pretty finished state, show them that you've actually spent time thinking about it. But the earlier you meet them, the better, because it just means that you're going to be able to create a relationship and show them you can actually execute on what you said you could execute on. So meet them early, whether they lead or follow, but be cognizant of what leading and following is. So, yeah.
That's great, thanks. Another thing that I think might have been a little confusing is the point about not really doing a lot of negotiating on your first round, right? Assuming that you're going to be giving away a substantial chunk of equity, 25% to a third. And then a second point that came a little bit later, which was this idea that you should only take the amount of money that you need, right? So I think probably if I'm sitting in the audience, I'm thinking to myself, okay, well, if I'm giving you 25%, but I'm not necessarily taking what I think the value of that 25% is because you're only telling me to take what I need, how does that sort of all gel together?
Yeah, I mean, so it's a very complex. I mean, there's a lot of debate around valuations and all this kind of stuff. I think the best way to simplify it is simply spend as much time building your product as you can, right? The most important thing is you build your product. The more time you spend raising capital and trying to optimize a deal that you're working on and get the right syndicate partners together, the less time you will spend building a product. And you will quickly realize that it is a CEO's full-time responsibility to always make sure there is cash in the bank. That is their #1 responsibility. So the more time you spend trying to fiddle and optimize, the less time you're actually going to spend doing stuff. But also, another interesting rule of thumb worth bearing in mind is when you raise capital, as I mentioned before, you generally are going to raise capital every year to 2 years. So if you look at Facebook, so the way raising capital works is your first capital raise is called a seed round. Your second one is called a Series A, then a Series B, and then a Series C. So I think Facebook now is probably on their series like G or F or something like that, right? Something very high. With the Series Seed, you're literally just trying to prove that something can get off the ground. And what you want to be careful of is to raise your next round investors, to make your previous investors happy. The rule of thumb is you want to give them at least a 2x increase, a double value for what they've invested in, right? Because they're taking a lot of risk on you. So if you raise money, so generally, let's say you're raising your seed round, and let's say you raise, the normal range is you're raising $1 million, right? And generally, if you're raising $1 million, you are raising capital at a $2 to $3 million valuation of the company. So you're valuing the company at $2 to $3 million because if you add the 1 onto the 2 or 3, you're left with a 3 to 4 post money. So after the money is in, so 1 out of 3 is 35%, and 1 out of 4 is 33%, and 1 out of 4 is 25%. So that's the valuation you're going to take. So if you cannot double that valuation next year when you try and raise capital, if your company, if you can't get investors to invest at a $6 to $8 million valuation, if they don't think conceptually that your company is worth that amount of money, it's going to be very difficult to raise capital at that valuation. If you raise it less, your investors who invested in the previous round are going to be like, God, I believed in you, I put my money in you, and all you've given me is, a slight little increase in value between when I invested a year ago when it was so much more riskier and today. So we're thinking about that. So another kind of general guideline I'll give you, and this may be different here in Hong Kong, but the rule of thumb, so when you're raising capital, the normal raise of capital, of valuation for a seed round, generally we'll look at seed rounds between a $1 to $4 million pre-money valuation. Okay, and I'm happy to clarify this valuation stuff, but you valuing your company at $1 to $4 million when you come to me, right? So if you, and by the way, that valuation is based on how advanced you are, right? So if you already have hundreds of thousands of users, you can probably get a valuation on the higher range of that 1 to 4. And if you just launched, maybe you're on the lower range of that. But if you come to me and you ask me for an $8 million valuation and you only have 10,000 users, then I'm not going to care. I'm not going to be interested in your company. So you need to be very careful that the value you raise, the amount of equity you give up, is equal to where you are in your company. Because if it's not, you're going to have a very hard time raising capital in the future. I may have just gotten way too complex, but I don't know.
No, not at all. You've done such a great job in this presentation that I figured I could actually throw a little valuation question your way
Right.
very comfortably, which I wouldn't ordinarily do under any circumstance. Right. One last question from me, and that is, so the standard, of course, thought is avoid VC money at all costs, right? Avoid the most expensive money. Try to get the cheap money, right? So let's say that you're growing organically, right? You're growing off as much cheap money as you can possibly find. One of the things that we've talked to the students here about is that with VC, you're getting money, but more importantly, what you're getting is networks and advice and expertise. And I mean, a lot of that rocket fuel isn't so much the cash as just sort of the heft and the expertise that comes along with the cash. So if I'm growing organically, I may not need the money, right? But I absolutely need the expertise. So I'm just curious to get, for them, they've heard our perspectives from me, from others, but I'm curious to get your perspective on where those advisors, where those networks, where those connections, where that other very important part of that rocket fuel on the organic side can come from.
Sure. Yeah, that's a good question. So I advised against raising VC, and I was a VC. I think there is value in venture capital in a lot of circumstances. I just think you have to be very careful. So many VCs, generally when you talk to a VC and you ask them what their value add is, right? What value are they providing above the capital that they are offering to you? They will tell you, oh, we help in all these different areas, generally with recruiting, finding new people, and that is very important. Finding people is very hard. But the best venture capital you can raise is from people who have been in the trenches in your specific area before. So what I would advise is, if you do have a company that's growing organically and you don't necessarily need the money, only take money from someone who has literally done this before, right? Who can literally say to you, look, I've built a dog walking company before. I know exactly who the dog walkers are. I can give you big relationships into, big dog walking conglomerates, and, I can get you all the connections you need, and I can do all this stuff. And most importantly, let them prove it. There's no reason, just like the VC will do a reference check on you, that you can't do a reference check on them and ask them for people who have worked with them before. But the best VCs will actually make introductions for you before the financing. So a great sign is when a VC, you sit down with a VC in the first meeting and they're like, oh, that's a great idea. Let me introduce you to 2 major dog walkers in the area you can sell your product to. And then we'll talk about it afterwards and see what their feedback on your product was. So that is the best thing. So venture capital is absolutely necessary. It exists for a reason. It is great if you have a product and you are growing a company, you need that rocket fuel. But just be very careful that you are really actually getting value from the people that are investing in you. So,
any tips on finding advisors if you're not going to go the VC route?
Yes. So that actually was a point I was about to mention, or I should have mentioned as an answer to the last question, which is a lot of the value you can get from VC, you can actually get from people without taking their money. So if you are a bright, young, passionate person, sometimes not even a young person, if you are just a bright, hungry, passionate person, people like to be around people like that. I've met so many cool and interesting people because the moment I met them, instead of saying, oh yeah, I'm working for a banking company, and then they turn off, right? I say, oh yeah, I'm working on this cool new idea to revolutionize the way that, people, get clean water in Africa. And immediately the person's like, oh my God, tell me about that. That's so cool. Let's talk about it. So the best way to find cool people is to work on something really cool, right? And something that's really, game-changing and, that people would really care about. Get yourself out there. Go to every single, startup event. There's a group called Boot HK. At Enterproid, we're thinking about having some hackathons and just some events at our office. Always welcome to stop by. Go to as many different events, industry events, everything as you can, and just talk about your idea nonstop. What I often advise friends to do is come up with, first of all, you should be able to pitch your business in 2 sentences. If you can't pitch your business in 2 sentences, you don't know what your business is. So the 2 sentences should be the problem and the problem people are facing, and then a demo, right? And your solution. and that's it, right? So for Enterproid, I would easily walk around to all my VC friends, even before I joined the company, and be like, hey, you know all these investment banks and consulting firms that give out BlackBerries to every employee? Imagine these banks are now in the business of maintaining and managing 10,000 BlackBerries, right? The costs and the headaches are ridiculous. So we've just created this beautiful little technology that allows you to put a work and a personal phone on one device, and you just show it to them. So 2 sentences, right? You should be pitching your coffee barista, your best friend, your dog walker, your whatever it is. And the more people you tell, the more probability you have of being exposed to people that can actually help you. So.
Any other questions?
Come on, guys.
Are you going to tell us about your education?
No. But come by the Enterproid office and yeah, we'll chat, we'll hang out. All of you are more than welcome. Reach out to me. I'll give you my email address afterwards, and always happy to chat. Just not over YouTube.
Any other questions? All right, please join me in thanking Justin for coming by. And have a fantastic Chinese New Year and break. We'll see you in a week.